This podcast series is presented by Archetype. Archetype is an early-stage venture capital fund focused on backing crypto entrepreneurs who are working to accelerate the decentralized future. We lead investments in seed-stage companies and are always open to speaking with crypto-native founders. For more information on our team and portfolio, go to archetype.fund. This season of Cross-Chain Examination is sponsored by Talos. Institutional investors across the digital asset industry have connected to Talos to access the entire crypto ecosystem via a single point of entry. Whether on the buy side or the sell side, from Wall Street's most storied firms to crypto-native come-ups, institutional investors are using Talos to accelerate their digital asset offerings. Talos provides technology infrastructure that powers the full trade lifecycle. Talos' integrated platform supports the entirety of the trading process, from price discovery to execution and settlement. Check them out at talos.com today. Hello, everyone, and welcome to another episode of Cross-Chain Examination. I'm your host, Catherine Wu. Each week on Cross-Chain Examination, we have on the smartest voices in the crypto industry to tell us what's top of mind for them. At this time of recording, which is November 11th, 2022, we are in the midst of one of the craziest, frenetic, sad, exhausting weeks I've ever seen in all my years of crypto. And as I was prepping for the podcast this week, it seemed to be one of those weeks where saying nothing at all seemed a little bit weird. So we will be breaking tradition and actually address some current events today. So with me today is Ash Egan and Danny Sursock, two of my colleagues at Archetype. We will be talking about current events and then turning to the topic of Ethereum, specifically Archetype's thesis on Ethereum and the recent model we published to put a number behind the value of Ethereum. Welcome to the show, Ash and Danny.
Thank you for having us.
Yeah, excited to be here.
Yeah, I'm very excited for this. So, big question, but we're going to start with Ash. Can you give us a quick TLDR, 2-3 sentences on what happened in the past week and why, in your own words, this week has probably been the most turbulent week over your nearly 8 years investing in the industry?
Yeah, it's been a crazy week. So to summarize, we had one of the leading figures of crypto, one that had been backed by very well-known funds in both crypto and in Web2, was sort of the point person in DC for ongoing legislation, SBF, and really what came down to a misappropriation of funds, $30 billion company collapsing. And we find out that this had been in the works for some time. Details are still coming out, but using user funds to do all sorts of things that these users did not agree to. So I think the breadth and how deep this contagion actually goes is something we're still finding out, but just a massive hit to trust, especially given all that was happening over these last few months, sort of regaining trust across Celsius, Three Arrows, sort of all that had happened a few months ago. So it's really unfortunate, and it's going to change the course and sort of require us as active participants to spend more time educating, rebuilding trust, and building that decentralized future that we all want.
Is there something about this week, because we're clearly in, markets pull back, macro conditions are terrible, and some people who have been around say, we've been here before, but why does this week in particular feel so awful?
I think it's just the scale. And, this is a $30 billion company, FTX. It had raised money from the who's who, Sequoia, pension funds, you name it. SBF had a direct line of communication with the SEC, with politicians, and, was pushing for a bill that would monopolize FTX's role sort of within crypto. And so I think just how close we actually came to that and realized what was, happening under the hood and just misappropriating user funds. I think, thank God this came out now versus, what if this bill had passed and how scary that would be. So look, it's just really unfortunate that it got to this scale in the beginning. We've seen FTX invest in a variety and Alameda invest in a variety of things over the years and, came out of non-typical origins, starting as a, prop shot and then trading against, users and things like that. But, just the scale of it was absolutely insane.
Yeah. Danny, what do you think some of the repercussions this could have on the industry, and what sort of things are you kind of watching out for in the next few weeks?
Yeah, I think one of the biggest areas where we're going to see effects is in institutional adoption. I mean, generally, I think we've crossed the point of critical mass in terms of education, onboarding, time, and capital, but this will set us back. And institutional acceptance is obviously extremely important for a bunch of reasons. General validation, funding, new users, new use cases, but even just inflows into assets like ETH, which we'll talk about. But the aggregate value of ETH in turn props up the value of the capital base that secures the blockchain. And so that's super important. In every institution right now, there's a small subset of people who've been fighting for, greater resource commitment and exploration into crypto against a much larger contingent of non-believers. And this week's events really hurt that cause. And so I feel for those people. And so we're likely going to see a lot of I told you so's in the form of pencils down and restricted activity in the space. And it could be at the cost of builders, true believers, and even talent inflow in the near term.
Yeah, I mean, the other thing to note, again, recording this November 11th, 2022, is that things are literally unfolding as we speak, and things are moving fast. Developments are happening as we speak. We'll obviously link to some coverages in the show notes that have covered this topic well so far, but just a caveat that everything we say, honestly, in a week could be totally different from now. So obviously, all of us in the industry have just been staying up until, 2, 3 a.m., maybe not even sleeping, nonstop doom scrolling, and sentiments are not great right now. In a week where the world feels like it's on fire and it's easy to feel super defeated, it's sometimes hard to find silver linings. And I want to focus a little bit on the silver linings to the extent that there is any that we should all keep in mind. So I'm going to start with you, Ash, and then we'll go to Danny.
Yeah. Look, this wouldn't be the first time you have a major player in the crypto industry blow up or even do things that are completely inappropriate with user funds. Events like these point towards having decentralized type systems. It really makes the case for what we're all striving to invest and help co-build. And so, I do think there's feelings of Mount Gox in this blow up. I think there's feelings of what we saw just a few months ago with Celsius and Three Arrows and just the contagion that it led to. And so I don't know if it's different in a lot of ways from these things, but I think where it's most relevant for us is what we saw in 2018, where after 2017, a lot of the capital disappeared for early stage founders and things like that. And we're encouraged to, our day job didn't change drastically when this news came out. We continue to sort of roll up the sleeves and partner with ambitious founders and try to, help them build something massive, either protocol or company. And so I think, this is definitely a setback, but the builders continue to build. There's a, heavier focus on infrastructure and decentralized systems. I think this hardens the mindset of a lot of people who have already been, building in this space for years and years. And the developer activity continues to be extremely promising in all these things. So it doesn't change sort of my outlook and excitement for crypto and Web3 in general. But look, it is certainly a black eye to the industry.
Yeah, look, I think from my end, Ash is right. I mean, the developer statistics tell a really good story of, retention of talent and continued activity despite a lot of the noise. And I think going back to my prior point, it's also on the institutional side, right? I do think we've crossed this point of no return, right? Institutional activity in the space is something of a barometer, I think, for progress that's been made. And it plays a big role in attracting talent and encouraging positive regulatory process. And, the data that we've been watching on our side, whether it's from institutions like Fidelity, who are reporting on behalf of the largest institutional investors in the world, art collectors who get reported via firms like UBS or BNY Mellon launching ETH custody and Bitcoin custody, the inbound activity from institutions over the last 6 to 12 months has been tremendous. And most of this has played out amidst what I think we would have called a bear market for much of the year. And so I think, look, FTX is going to set things back, but I think it's important to note how far we've come over the last 6 to 12 months. And as a result, I think this is a sector and a technology that, it's going to continue to evolve, but it's not going anywhere. And I think that this will ultimately be a really valuable catalyst for accelerating progress, maybe even regulatory clarity, whereby they're forced to bring action to the table. So, look, I think there's going to be some positives in the longer term here.
Yeah, I mean, obviously, Markets are cyclical. We've been in situations where things seem pretty bleak. I would say this event over the last week was a huge betrayal of trust that we've built, which I think is what feels extra frustrating, is that the builders in the space and advocates for the space and folks like you and I have been advocating for ethical, sustainable company building and products for a while. And so feeling like there was a gigantic betrayal of trust in just within the industry and also externally is not great. But in the last cycle, think about all the things that were built. I think just within the last 2 years, DeFi and NFTs have reached insane milestones that if you told me in the last bear, I would not have believed. And so holding on a little bit to that hope and also being encouraged by, honestly, the talent that we've seen just in the last month or two.
Yeah. I think just to add to that, we're sort of dawn of the application era for crypto. You had DeFi, it really came to early signs of product market fit in 19, but really 2020. You saw the same thing with 721 standard with NFTs and really seeing product market fit amongst, sort of digital artists and the sort of being sort of extended to a number of different areas. DAOs sort of, didn't really hit critical mass or scale yet, but I think there's some really exciting things happening around coordination of freelancers and sort of the open source digital economy. So look, there's a ton of exciting stuff happening from a product standpoint. And, I do think it's a really important thing to note. Like, we as an industry have gone a long way over the last few years. And so I think we're still in sort of trying to understand the situation mode, try to figure out what the contagion is. And then from here, we're also thinking through, okay, what's the path forward? And there definitely is a path forward.
Yeah. Speaking of silver linings, thanks to Ash and Danny. So we published our piece titled Valuing a Social Computer about 2 weeks ago, where we outlined our thesis and valuation for Ethereum, which I read back this morning, by the way, and it read super optimistic and bullish. So I think it's a good topic to talk about today and this week. And just before we do that, taking a moment to just emphasize how difficult this was. I know Danny basically didn't sleep for 4 months doing this. And also, storied Wall Street research desk just in August or just this year have actually said that they were not able to forecast cash flows for blockchains because they were unpredictable in the nascent industry, which I think we can find data to refute that. So let me ask you, Danny, first, why is it so hard to do a DCF for Ethereum? What properties make it difficult or different from a normal, traditional Web2 company?
Yeah, it's a really good question. And it actually gets to the core of crypto, really. Part of the historical challenge, I think, stems from a discomfort around the concept of tokens and blockchains themselves, right? There's this huge reliance on the belief that with traditional equity, you have these contractual claims or ownership over a business, even though as a shareholder, you aren't always on the receiving end of cash flow directly, right? And this is a domino that will eventually fall, just given where we've been trending for decades, right? At the high level, our monetary system is effectively underpinned by, nothing more than collective consensus and an idea and a government. And its reserve asset alone has lost, 90% of its value over the last many decades. And so that's sort of one step forward into exploring tangibility relative to, value and ownership. It's likewise, how we think about assets generally. Well north of 100 billion was spent on virtual goods last year. And most of us live a substantial portion of our lives on the internet. And so our societal understanding of what value really looks like, relative to either physical or contractual tangibility has evolved a ton, and it will continue to do so, I think, in the context of companies and protocols as well. And so, that's sort of the first bucket, I think, that's been a hurdle for a lot of people coming at it from a traditional lens. The other thing is blockchains like Ethereum, they sort of unlock this symbiosis, right? This entwined environment of immersive worlds that, see culture and capital and entertainment and ideas come together natively around this really expanded understanding of value. And tokens ultimately are the first digitally native asset that actually work in a system like that. And so the other challenge is that prior to the merge, there wasn't really an example of a protocol or a blockchain with durable cash flows that could actually be quantified in terms of, true token holder value capture. And so the merge introduced a really, really important dynamic by which 100% of Ethereum's transaction fees now flow through to the holders. And so you can actually build a valuation model around true cash flow generation. So part of it is, I think, just general, historical biases and understanding of what ownership and value look like. And the other part is actually really important dynamics that have changed and been introduced by, the merge and the events in Ethereum on a protocol level for the last, few weeks.
The other thing I think that makes it pretty hard is just your benchmarks are different. Like where you look for data is different. How you think around, for example, protocol revenue. Where do you think about the future economics of Ethereum? I think it takes a specific knowledge set to even know where to look for.
Yeah, I think that's a really, really good point. And look, you need to ultimately balance crypto native resources and crypto native data and metrics and come up with figures that are actually, indicative of what's happening on blockchains and somehow reconcile and tie those to the metrics that are used in historical valuation frameworks. And so that was probably one of the biggest challenges that we faced in terms of the last months, not just, how do we build this model, but how do we actually, almost translate two very different languages into one that actually spits out a number that really makes sense in the context of effectively two different economies and two different worlds that to date don't really live side by side. So yeah, you're absolutely right. That's the other big challenge there.
Yeah, I think with any asset that also has technology baked into it, it just takes a different set of considerations. On to the core of the model, and I think what everyone cares about. Let's break down our findings from a bottoms-up approach. So as we sat down to do this, what were some of the important pieces and parts to get together? What were some of the really important assumptions that had to be made in order to confidently put number into model?
Yeah, Ethereum is a lot of things, right? That's the first thing to note. It's this fascinating ecosystem. It's a blockchain. It's an asset. And so our intention here was to build a true bottoms-up analysis in a way that told the story of all three in order to ultimately derive this valuation model around it. And the way we effectively did that was by building these models around each subsector where ETH and Web3 is dominant today, right? And then benchmark those against traditional comps. And then we would use those comps forecasts as the corresponding growth rates with which we would project the total markets out. And so things like DeFi, for example, and within that it's DEXs and lending protocols and asset management, staking solutions and whatever, benchmark against traditional industries like retail banking and corporate banking and payments and wealth and asset management. And we did that for sectors like music and gaming and e-commerce and virtual worlds and art and a few others as well. And so part of it was just building the parallels between what the Web3 industries look like and creating the actual, comps with which we could translate to the point I made earlier. And, what's really important in the way we approached it was in recognizing that there's a couple things that make Ethereum really special, particularly in a world of open blockchains and protocols. In valuing anything, there's a few things you need, right? You need visibility into long-term supply. You need reasonable liquidity or float. You need visibility into value capture in terms of actual cash flow generation and receipt. And ultimately, you need a competitive moat so that you can forecast this out over many, many years. And post-merge, Ethereum is really unique in satisfying these conditions. I mean, even on a blockchain level, right? The vast majority of other blockchains are advertising either super high throughput or cheap fee environments. And as a result, they can't really connect any meaningful fee revenue. And so that in turn means that they're paying for their security via issuance. And if you're paying for security via issuance, then the currency itself inflates and leaks value over time. You can't just build a model around that. And so Ethereum is alone in having developed this really sustainable economic model and actually finding almost product market fit from a blockchain that's selling block space, right? So that's the first dynamic here. Beyond building this bottoms up TAM analysis and the valuation model, with no real precedence, right? The other thing that we did was we delineated between value capture from stakers and non-stakers, because these are really important differences here. And so as far as key assumptions and inputs go, there were a few that we worked off of, and I'd mentioned them before. The first is the moat, which is really, really important, and it's sort of the core in terms of being able to actually forecast out over many years. And so on the moat, there's a couple things, right? One is, I think, this early mover advantage that we've talked about before. And we give credit to Bitcoin where credit is due, and they sort of laid the foundation. But Ethereum sort of revolutionized thing with its design as this universal computing machine, right, that can support such a wide range of diverse applications. And so as a result, Ethereum's just been the primary domain where so much of crypto's innovation has taken place over the last many, many years. And as a result, that feeds into the second advantage, which is this flywheel for technical talent. And so it's this early dominance that yields this really, really vibrant ecosystem of tools and application, but importantly also technical talent. And so you end up with these almost reinforcing network effects. And even in a challenging market, for example, the active developers working on Ethereum are 7x larger in total, quantity than across the average of any other major ecosystem. And so that's just its durable advantage there. The other thing is its architecture, right? So Ethereum's approach famously has positioned it to be, prioritizing decentralization and security, whereby others have made different trade-offs to solve for cost or speed. And the choices that Ethereum has made at its base layer architecture means that it's capable of hosting thousands of applications and settling trillions in economic value. And that's really important from an economic capacity standpoint, but it's also important because it's the only blockchain that's actually demonstrated the ability to literally host trillions in economic value, because that's what allows us to forecast it out, right? I don't want to name names, but you couldn't forecast out certain other blockchains to theoretically trillions in value because they would collapse, right? They just couldn't support it. And I think the other assumption that we made was sort of recognizing that there are other players that have potential, and whether it's EVM ecosystem participants, it's layer twos, side chains, they're also though going to drive demand for ETH as a core unit of account and a medium of exchange. And so, that's sort of something else that we've thought is a dynamic here. There are a couple other really important assumptions that play into this that are specific to the merge. The first is that in order to, dependably run, I think, a global permissionless supercomputer that we're talking about here, you need a security mechanism that is decentralized and digital, right? It needs to rely on distributed participants and not the accumulation of costly physical or really digital assets. And that's an important point, right? Like proof of work systems inevitably lead to centralization around really expensive resources, whether it's land or it's capital or it's technology. And so that's a really important point that extends into the idea that proof of work also has intrinsic sell pressure, right? Miners have real world costs. And so that necessitates the selling of newly minted tokens on a continual basis. And so suddenly we've alleviated a lot of this downward selling pressure, right? Assets don't depreciate in a proof of stake world. There's no OpEx related sell pressure that you have to account for. So that's really, really important. Another thing is the merge introduces a 90% issuance reduction alone, right? While fees stay relatively constant. So that's what gives us the ability to project out the total supply, which is another very, very important dynamic here. And then most importantly, from the perspective of holders of ETH, right, it's what we talked about before, which is revenue now passes through in entirety. And so just as a quick refresher, right, post-merge, transaction fees are composed of two things: the base fee, which gets burnt, which reduces supply and creates value in the form of something like a stock buyback, indirect value capture. And the other is the priority fee or the tip, which goes directly to the validators. And that's part of that reason why we thought it was important to delineate between stakers and non-stakers in value. So now you actually have this mechanism by which asset holders are recipients of cash flow directly. And that's the foundation that we built our model on. So, when we bring that all together, we now build this, really detailed model that accounts for Ethereum's cash flows when we factor in the implied growth rates from the different total addressable markets that we forecasted out. And from there, we take the inputs that we just talked about and we start building this model out based on that compounded annual growth rate that weights everything together. And importantly, just a reminder, this is the base case price projection. It's strictly based off cash flows from Ethereum's core business of selling secure block space. And so it doesn't necessarily factor in other accounts of value. And we talk about that a little bit later in a monetary premium, but just want to point that out here. And so ultimately in the value output, we, sensitized across a range of total supplies by the end of the decade. 100 million total supply is our base case long-term. We base that off of our research, discussions with people like Justin Drake, person who joined us on this podcast, I think, but we do sensitize across them. We then differentiate between stakers and non-stakers. And ultimately the output, which we think is extremely conservative, is for our base case with, no premium multiple, we get around, 13.3K for stakers for a projected price and 9,000 for non-stakers. And, the application of, I think, an important but modest monetary premium multiple of around 2x, those numbers double, right? So to 23 to 18K respectively. And so that's really the high level of how we went about it and what the ultimate outputs are.
I think there's still, of course, a lot of unknowns here. I can't even put my finger on how many conversations we had around what is the total supply of ETH at scale. And we talked to Justin Drake on this podcast about that. And then we talked to him again at DEF CON. We're like, hey, this is where our head's at. Like, is it fair to say 100 million? But look, there's certainly a level of uncertainty for these things. And so this is our attempt to put real numbers around, ETH as an asset and what it can get to. And, you see other teams that post, ETH will be you sort of back into it from a 10 trillion network value kind of approach. And we're sort of like, okay, bottoms up. How can we actually put cash flows around this, looking at block space, looking at what's working today, and looking at what could be. And so it was definitely a long exercise, but Danny crushed it.
It's funny because if you actually go in and read our assumptions, which you definitely should, we publish it on Bankless. Again, I'll link it. But if you go in to read our assumptions and thinking through projecting out today versus we were trying to do this exercise maybe 2-3 years ago, all of the assumptions in the sectors would have looked really different / non-existent because, Danny, I know what you did was like you took sectors from Web 2, kind of like figured out what they were worth, but that's like music, that's like gaming. I don't know. I think there was a digital fashion sector. Yeah. Like all of these, I'm not even sure 2-3 years ago, we would have really thought of as like major breakout sectors within the Ethereum ecosystem. So goes to show again, this is what we're projecting out today. Who knows in 3 years, 5 years, what other sectors will emerge?
Yeah. And I think just another thing to note here, like there are certainly going to be new markets that are created. And so putting your finger on what those look like, how big they'll be, I think it's just impossible to do a lot of that stuff today. But, as early stage investors, sort of the holy grail in terms of where teams could go, assuming they launch a protocol is, can the protocol kick off tens of millions in annual cash flow and revenues? And so, these are things that we're looking to actively invest in and sort of drive Ethereum, but drive, Web3 cash flows, revenues, and all these things. So it's fun sort of living that on a day-to-day basis and then, trying to put numbers around it. But some of these things are just frankly really hard to put numbers around.
Yeah. And for sure, we are super open to feedback. So just add us if you go read it and have questions. Any of us will be happy to answer. In the spirit of having a balanced discussion, I don't want to kind of skim over any kind of risks or considerations there. So Danny, what were some of the risks, considerations that are important to keep in mind as you read this piece?
Yeah, and we outlined them, I think, in the model, but high level, we were super conservative, I think, in how we went about this, right? And there's a number of dynamics there. One is, the future may ultimately be multi-chain, right? But we really do think that Ethereum is going to remain the standout leader for a variety of reasons. One of the biggest ones is, I think, what we talked about, as trillions in value ultimately come on chain, a substantial portion of the highest value will continue to transact on Ethereum's mainnet for, a number of reasons, namely reliability and security. And so, while that's our belief and we believe in the network effects and the entrenched traction that attracts users and developer mindshare, regulatory recognition, institutional acceptance, we also are, excited, I think, in many ways about layer 2 scaling solutions. We even, are pretty accepting of value in select competing blockchains. And so what we've done there is we effectively modeled down the dominance of ETH from around 80% today to 60% by decade's end. So that was sort of one way in which we tried to, moderate, I think, our projections here. The other, Catherine, as you touched on, is we didn't bake in new or expansion of markets, right? So we basically went with what is existing today. And there's no question that blockchain technology and the talent in the space are going to think of incredible new use cases, just like it played out sort of in the early broadband days of the internet. So I think that there's substantial potential for higher upside here that we're not even capturing. The other things are obviously regulatory threats, right? And that's only probably increased given the events of the last couple of days. And so we've basically applied discounts to the year-by-year projections that we've made to account for the potential that some of these, forecasts don't actually play out. Another bucket is sort of increased headwinds, both macro, but also crypto specific. And, these are really important to account for and they play out in a number of different ways. And so we've also sort of accounted those with discount rates. But, a lot of them could be just drying up liquidity in DeFi as we enter in a prolonged bear market and things like that. So we're just trying to account for those. And the other thing is, maybe on a final point, we're very careful about taking the most conservative growth rates for the industries which we comped with from, traditional Web 2 markets. And I think that's a very different approach than a lot of other people took because, you're going to skew slower growth rates for traditional markets like music and finance and traditional art. And that's a weighted average that we're using there, right? Whereas I think a lot of the other approaches, they not only didn't do a bottoms up approach, they also sort of took something like a SaaS growth multiple and they applied it to the entire sector. And, the truth is, as so many different ecosystems and industries come on chain, they're not all going to look like explosive growth potential. Some are going to be slow, steady, boring. And so it's really important, I think, that we capture a picture that is super diverse in the use cases and doesn't over hedge on one specific outcome or use case.
It's kind of funny because right after we published it, I know we got a couple of like pretty troll comments about, oh God, like, why aren't you guys more bullish. But I think if you look back, this will be actually the most bullish piece to have published in this quarter in 2022. Okay, last question, and this is more like general, which is as a firm, we tend to have and probably will continue to skew Ethereum first in terms of teams and ecosystem that we back and are bullish on. Ash, looking back at this year and also maybe into the next, tell the listeners why you continue to be so excited about Ethereum as an ecosystem.
Yeah, if you just look at the data, year over year, the number of dApps with active users hit a record, increasing 12x to 12,000 different dApps. Smart contract developers surged 40% to all-time highs, sort of just recently. A third of smart contracts ever deployed and verified happened this year. And this all happened while, Ethereum's prices come down substantially from its all-time highs. And so, I think you look at the developer activity, dApps getting deployed, new things that are being experimented with, and it's incredible. I sort of hinted at it earlier, the different segments that have been built out. You have DeFi, you have NFTs, you have sort of marketplaces, you have DAOs. There's, we think, a number of very exciting things happening, and on the payment side and sort of businesses coming on chain, et cetera, et cetera. Sort of none of this is looking towards the, sort of what's happening with L2s and ZK and sort of all the ancillary pieces that are core to the Ethereum stack and to mainnet. So look, of course, the past few days have been crazy, just given what's happened with this FTX blow up. But, you look at the data around developers and dApps and the activity, and we continue to be so excited about where this space is going.
Awesome. Well, I hope this episode gives us all a reason to remain optimistic and bullish, even in light of this horrible week. While trust feels like it's been broken, it really shouldn't negate the great work that builders are doing in the space. The number of CeFi breakdowns this year in exchanges and lending platforms point to the tenacity and longevity of DeFi. We are learning a very hard lesson here that we need more diverse voices in the industry to speak up, engage, and educate. With every loud and sensational fail, there are thousands of quiet builders that are working towards building a decentralized future. In the US and DC, there are still amazing folks working to rebuild that trust and institutional capital, such as Archetype. We are still here. We're ready to back talented builders and continue to see excitement among builders who are ideating, executing, and shipping product. So thank you, Ash and Danny, for your time on the show today. Show notes will again have links to all the topics we covered today, and we'll see you all next week. Thank you all for tuning in to another episode from Season 2 of Cross-Chain Examination, hosted by Catherine Wu and presented by Archetype. If you like this episode, please give it a 5-star rating, like it on YouTube, and subscribe to the show if you haven't already. Also, make sure to check out Season 1. We have 10 episodes from awesome guests talking about all kinds of topics, from privacy and crypto to crypto regulation to many, many other topics that I care deeply about. Share this also with a friend, with a coworker, maybe even family if you enjoyed it, and give us a follow on Twitter. We are at CrossChainPod. DM me, at me with any suggestions, guests you would like to hear, and anything else. Thank you so much again, and hope you tune in to our next one.